Hello, and welcome to today's webinar on property versus pensions. My name is Tom Kimchi, and I'm the Head of Advice at Netwealth. And today we're going to be talking about property and pensions and how you might best invest, whether it's for your retirement or just for the future in general. So I'm going to start by introducing the current landscape with regards to properties and pensions. We're going to look at the economic backdrop and the UK property market in particular. We're going to have an overview of recent legislation, changes that have been made to taxation for both property and pensions. There have been quite a few, and there may well be some more in the future. We're also going to compare the benefits of both styles of investing. We're going to look at the pros and cons, and then finally, we're going to look at Netwealth and how we might be able to help you with some of your decision-making around these areas. If you have any questions at all, please feel free to book a meeting with us or to ask the question at advice@netwealth.com. First, I'm going to provide an introduction on the landscape and how you might position yourself when thinking about how much of these different types of asset classes to hold. So we have a theory at Netwealth called the free pot theory, which is a way of thinking about your overall asset base. And we break down different accounts you might hold by how liquid they are and the sorts of returns they might generate in the long run. So pot one is a pot that everybody should hold, and that is cash primarily, but it's any pot of money that is very, very low risk, very unvolatile, and it's there for a rainy day or as an emergency fund. So everybody should hold some money in pot one. Often we find clients build up too large a pot one though, because they just don't have time to think about investing or don't end up making the right decision. Jumping to the other end, first of all, we have pot three investing, and this can be things like property, it can be single stock positions, it's things that can be very volatile, they can be illiquid, they can sometimes lead to very strong returns in the long run, but they can be quite hard to sell in a pinch, and they can be quite hard to value at certain times as well. So whilst these investments can be good, and you can also just get utility from owning property, say, they're not necessarily the best place to hold all of your wealth, because if you need to sell part of a property, it's quite hard to do that. You need to sell the whole thing or nothing at all most of the time. So in the middle of these two pots, you get a diversified low-cost portfolio. And this could be your pension, this could be your ISA, it can be a general investment account. And these types of assets tend to have a slightly more predictable path of returns. You tend to be able to get a price for them and be able to sell them in smaller quantities than the whole thing. So we think that clients should generally have a blend of these assets. And if I move on to the next slide, you can see a journey of how this might look over time for people. So when you're quite young, you might have some money in pot one as you're building up a deposit to buy your first property. As you get older, you might buy that property and then have lots of money invested in property, and then you might start to build up your pensions and your other accounts such as ISAs. So over time, it's quite natural for these pots to evolve. And what we're going to focus on today is how you get the right blends. And of course, it'll be quite different for different people, because some people might have quite an expensive primary residence. Other people might just really value the liquidity and not want much in property at all. So things will change over time. And you can see towards the end of this chart here, when somebody is a little bit older, they might have spent down quite a lot of their pot two investments as they've funded their retirement, but maintain their property. So it is very natural, as I said, for these things to change, but it's just important to be quite careful that you aren't overexposed to one or the other, either leaving yourself in a position where your portfolio is not very liquid at all and you can't actually access it, or on the other hand, you're too liquid because all of your money's in cash and you're not getting a return that is appropriate. So where are we macroeconomically, and where is the property market at the moment? I'm going to start by thinking about inflation and where we are at the moment. So this chart shows inflation going back quite some time. And the main takeaway here, I think, is that inflation has generally stayed low, although it has been positive. So inflation is likely to stick around. You can see we have this large spike after the pandemic, which has now thankfully largely gone away, although it is still above the Bank of England's target of 2%. And the real importance of inflation when investing, of course, is making sure that whatever you invest in earns a return ahead of inflation, so you're maintaining your purchasing power. But the other important thing about inflation is the impact it can have on interest rates, because interest rates are one of the central bank's main tools they use to control inflation. So you can see again, interest rates are quite low and have been low for quite some time, but back in the 90s, they were much higher. Now we're at 4.25%, and it's likely to come down, but still higher than it has been in in recent years, where you can see it was pretty close to zero for quite some time. And the impact, of course, when you're thinking about property investing is quite often you'll need a mortgage to buy a property, or you'll want a mortgage. And when interest rates are higher, you're going to pay more for that mortgage, which is going to impact the net yield you get when investing in a buy-to-let property, say. Interest rates are also important for investing in a pension or in a more diversified fashion, because interest rates will affect the amount of return you get from bond holdings. They play a part, certainly, in the return you can expect on equities. So it is very important there as well. But if interest rates come down, that will tend to be beneficial for property investors, as they can borrow money at a cheaper rates. When I'm talking about property in the context of this webinar, I'm mostly going to be talking about residential property, because that's the most common way investors think about, or retail investors at least, think about investing in the UK property market. And when I'm talking about pensions, it's largely going to be in a diversified portfolio in a pension, which I'll come to later on. So where are we with mortgage rates? Well, they have certainly risen relative to recent history, again, because of interest rates. And you can see they're not quite at their all-time high here. So the blue line there shows the mortgage rate of a 75% LTV mortgage from a 2-year fix, and how that's fluctuated over time. Again, it's trending downwards now, but still much higher than it has been in recent years. So for those thinking about investing in properties, it's not quite as attractive as it was based purely on mortgage rates a few years ago. But if that trends down, that will be beneficial. It's not trending down very quickly at the moment, though, and it's still well above where it was, say, in 2022 or 2021. When thinking about property investing as well, it's always important to think about affordability. And this really has implications for how much capital growth can happen in the future. So looking at this chart here, first of all, it's important to note the affordability threshold, which really is a reflection of the mortgage the average person can get. So it's based on 5 times earnings to house price, and that's based on mortgages and what you're likely to get at the upper end. If you go to a bank and you want to get a mortgage, they normally won't give you one for a mortgage greater than 5 times your earnings. Usually 4.5 times would be the cap. So once we're above that threshold, which we have been for some time, it means that houses are becoming much more unaffordable for the average person. You can see the rate in England and certainly London has been well above that affordability threshold for quite some time. Now, affordability has gotten better in the last couple of years, as you can see on this chart, when the line tends to trend back down, but it still has some way to go before getting below that affordability threshold, as it was before the year 2000. So this just gives you food for thought when thinking about how much capital growth to expect, because if you aren't expecting much capital growth, because it is going to be hard for people to afford houses, whether it's yours or new ones being built, then it means you need to be even more focused on the yield you get from the property, the rental income versus the mortgage cost you pay. So affordability does remain pretty stretched. Moving on, we look at the price of rents at the moment and house prices more generally. So this chart, first of all, looks at rental inflation, which is the dark line here. And you can see it was pretty steady before the pandemic, but it's increased pretty sharply. And we'll come on to some reasons for that. So if you do own property, it's good, of course, if you can charge more rent because your yield will go up, but not so good if you're charging more rent because your costs have gone up by the same amount. So that's an important one to keep an eye on. You might also say that affordability for rents has become quite high, so it would be harder to increase them further in the future. And house prices is also an interesting one. Again, it feeds back into capital growth you might expect in the future. And we saw, again, as most of you will know, I'm sure, lots of house price appreciation just after the pandemic, lots of money flowing into properties, but then a steep decline, certainly in the rate of inflation, but also in the absolute value of houses more recently, although that started to improve slightly. So rents are higher, house prices have fallen recently, but are still much higher than they were some time ago, which is why affordability is stretched. And then comparing to pensions, I just wanted to give an indication of what markets have done generally over the last few years. So here I've just shown 3 different net wealth portfolios. So we have risk level 5, which is quite a balanced portfolio, risk level 7, which is a more adventurous equity-based portfolio focused on company shares, and a lower risk level 3 portfolio. So depending on where you are in your investment journey, if you are thinking about a pension, it could be that you're some way off retirement, so maybe risk level 7 is more appropriate to think about. It could be that you're actually about to retire, so maybe risk level 5 would be more appropriate, or risk level 3 if you were more cautious. But the idea here is just to show you the trajectory of markets over time. You can see the falls around 2020 because of COVID, and then a pretty strong period of recovery since then, although 2022 was also a slow year. But following some of the recent political moves, particularly in the US, we've seen markets recover most of that lost ground. So we're in quite a good position if you've experienced most of that investment journey over the last 9 years that you can see on this chart here. And again, when I'm talking about pension investments, although you can invest in lots of different asset classes, I'm going to largely be focusing on diversified portfolios. So that means a portfolio that's invested in a range of asset classes that can complement each other, and each asset can perform well in different environments. So if, say, for example, equities are doing badly, it might be that your government bonds are doing quite well, as we saw in March 2020 in particular, which is one of the core benefits of diversification. So here I'm showing you the 7 different net wealth risk levels, and the different colors represent the different asset classes, with green being equities, blue being fixed income or bond assets, and yellow being alternatives. So if investing in a pension, it's likely that you will have some diversification, certainly if it's being managed by a professional manager. And I think it's worth mentioning that pensions can certainly invest in property as well. So it's important not to miss that topic, but they can't generally invest in residential property. Now, there are some very small exceptions, such as investing in a commercial property and it has a residential property attached. But most of the time, when you do have a property inside a pension or property holdings inside a pension, it will be either a commercial property, which can be held directly in some specialist pensions, but more commonly, clients will have investments in what's known as a real estate investment trust, which is essentially a company or an investment company that holds properties, or you'll be invested in companies that build houses. So that also gives you exposure to the UK property market and the UK residential property market if the company invested in builds houses, builds residential properties as well. So that's definitely worth noting, that you don't have to exclude property altogether if choosing to invest in choosing to invest in a pension, rather than a second property. And now we're going to look at some of the key features of each type of investing and how they compare. So we're going to look at some of the features of investing in a buy-to-let property, say, which would be the most common way of investing beyond the house that you already live in, which is quite a different proposition, actually, because, of course, when you buy the house that you live in, you're going to benefit from living in it before you're benefiting from the investment side of things, which is often a bonus later in life if you sell it for a profit. But if you do have some cash to invest, then it's normally going to be a buy-to-let property you're considering versus, in this case, a pension that you're considering. So looking at the features, with buy-to-let properties, you don't receive any tax relief when you invest in that property. You have to use your cash. As we'll come on to later on with one of the examples I've got, it can actually be somewhat the opposite, because not only do you not receive tax relief, you actually have to pay quite a lot in fees like stamp duty and maybe new furniture or renovating the property. And when you sell it, you might have to pay an estate agent to help you with that process. So you certainly don't receive tax relief on the way into the investment. With pensions, you can receive tax relief for your marginal rate of income tax, which can be 60% for some people, but it can also be more commonly 40% or 45%. So that's quite attractive. With buy-to-let properties, though, you do have the ability to use leverage, which is really getting a mortgage, only paying part of the money up front. And then in an ideal scenario, from a property investor's point of view, your mortgage rate will be less than your yield, your return, and that will add up to your benefit, add up to your advantage as well. With pensions, you certainly can't borrow money to pay into your pension. Technically speaking, some of the investments within your pension could use leverage, which can enhance the return, but that's quite a risky strategy. Generally speaking, it's fair to say that you don't benefit from leverage with a pension investment. Moving on the amount you can pay in, that's a very important one to be mindful of. So with buy-to-let properties, there's no limit on how much you can spend. You could spend £10 million, or you could spend £100,000 on quite a low-cost property. With pensions, you are capped on how much you can pay in any given tax year. There are various caps, which I won't go into in a high level of detail now, but the annual allowance is £60,000 for most people. You can use unused allowances though from the past 3 tax years, which can help you to pay in more. So for most people, they're not actually going to be capped on how much they can pay into their pension. Some people will be, but often people can pay more to their pension than they think. And the next thing to think about is the growth on the investment itself. And this is one of the most important factors over the long term. So with a buy-to-let property, certainly not tax-free growth. You have to pay tax on your rental income. You have to pay tax when you sell the property for a gain if it's a second property. With a pension, on the other hand, all capital gains, all income, whether it's dividends or interest, is tax-free. You do pay tax, however, when you take the money out of the pension, but hopefully less than the tax relief you received when you made the initial investment. In terms of restrictions on accessing the investment, this is also quite a key difference. So if you're over 55, there is no difference. But for those that are a bit younger, then with a buy-to-let property, although it might be difficult to sell it at short notice, you can do that and get your money back, get your cash back. With pension, if you started this when you were 30, say, for argument's sake, then you've got 25 years at a minimum before you can access it. And then the final one, which is changing fairly soon, but nonetheless worth mentioning for now, is the inheritance tax treatment of pensions. So pensions up until 2027 are outside of your estate for inheritance tax purposes. So if you were to pass away, your beneficiaries can receive that money without paying any inheritance tax at all. They may pay income tax though, if you pass away over the age of 75 at their marginal rates. But for buy-to-let properties, they are fully taxable for inheritance tax regardless of when you pass away. So until 2027 at least, that's an advantage for pensions for those that are mindful of inheritance tax and estate planning. I've mentioned at the bottom here that ISAs and general accounts are also very sensible to consider. So although we're focusing on pensions today, many of the arguments apply to ISAs as well, albeit the allowance is smaller at £20,000 per annum. So it might be that it's not that significant if you're thinking about a large sum when investing. But nonetheless, if we're looking at a couple, say 2 spouses, then you can have 2 sets of ISA allowances. And with general accounts as well, if the general account isn't too large, often the returns can be tax-free or very close to tax-free because of some additional exemptions you get with capital gains and with dividends. Moving on, I'm looking at some risk now to consider for all investments, whether that's properties or pensions. So liquidity is a key risk, and it applies a little bit more to properties in this case because it talks about how realizable this investment is. And with properties, I think people tend to appreciate that it's going to be a fairly long-term investment. Of course, some people do buy a property, renovate it and sell it, but that's more of a business in itself. With the average property, people plan to hold it for quite some time. So people ignore a little bit the fact that values can become depleted at short notice, and they tend to think, actually, I'll just hold on to the property until things recover. But nonetheless, if you absolutely need the money in the short term, then it is going to be quite hard to get a fair price. And this can apply to lots of investments within a pension as well, actually. So if you're not invested in the right funds, the right sort of holdings, it can be that some of your pot 2 investments aren't as liquid as you thought. But generally speaking, if you invested in quite a sensible way, then your pension should actually be quite liquid and you should be able to sell assets at a fair price when you need to. Another risk is credit risk. And when thinking about pension investments, diversified portfolios, this tends to apply to bonds that you might hold in a lower risk portfolio. Are you going to get back the interest you should from your bond investment? With property, the most similar thing would be your tenants and then paying the rent they owe you on time. Always a risk. Reinvestment risk is another one. Looking at, are you going to be able to get new tenants or a new lease when you need to? Again, it shouldn't happen, but it can happen and can leave your investment much worse off than it initially seems. And then the final one applies to both properties and pensions and more diversified portfolios, but it's volatility. And it's the fluctuations and the fact that the portfolio might be worth less than you want it to be when you actually need it. And again, with property, because people don't tend to sell when market values are depressed, it doesn't seem quite so apparent. You don't get a daily valuation on your property that you do on your pension, but that doesn't mean behind the scenes there isn't actually volatility in what someone would actually be willing to pay you. So let's look at now some changes to rules with regards to pensions and property, and we'll start with pensions, looking at some of the legislation changes and how that affects you and the merits of this particular style of investing. So when it comes to pensions, recently we've seen the annual allowance increase to £60,000. I say recently, it was a few years ago now, but that is welcome for people who want to save into a pension. And of course, as I mentioned, you can use unused allowances from the previous 3 tax years. So you can use this tax year, 3 previous tax years, and pay in well over £100,000, assuming your earnings are that high and you have the cash, of course. The lifetime allowance tax charge was abolished, which means that there's now no punitive tax charge once your pension has exceeded a certain threshold, which is again beneficial. However, tax-free cash is capped at £268,000 or slightly higher, which is 25% of what was the old lifetime allowance. So if your pension is well below £1 million, that's not a worry. You can top up your pension and know that you'll get 25% tax-free. But if your pension is already worth more than £1 million, there won't be any more tax-free cash. Pension freedoms allow you to access your pension flexibly. You don't need to buy an annuity anymore, which is quite beneficial for those that either don't think they'll live a very long life and won't need an annuity that goes on for a long time, or for those that just want to be able to flex their income. And as I mentioned, pensions are currently outside of your estate, although this will change. The final thing I wanted to highlight is that future changes are, of course, possible, and this is particularly relevant at the moment. We don't have any inside information, or we don't think that one particular course of action is more likely, but it's often rumoured that certain things will change. So this is where we are today, but it's worth being mindful that things might not quite be like this in a year's time, say, which is one reason why it's good to review your plan, your strategy on a regular basis. Now we're going to look at some of the changes to buy-to-let properties. And these changes, I would say, have been more significant and more negative in recent years. So one of the changes is the increase in the capital gains tax rate. So you now pay 18% as a base rate taxpayer or 24% as a higher rate taxpayer when selling a property. And that's on the gain you experience. When buying a second property, there's a 5% stamp duty surcharge, which takes the top rates on expensive properties, but nonetheless to 17%. So that's an initial outlay, and that money won't come back to you, which is something to bear in mind. It means that your return has to be that much better to get you to where you were. It happened some time ago now, but now you cannot claim your mortgage interest as an expense relative to your income from the property. You can claim 20%, but no more than that if you're a high rate taxpayer. So that makes the return you get not quite so attractive. And the other thing that's affected the market, and it's affected some of the stats we looked at earlier, so the value of house prices, for example, the number of properties on the market, and rental costs, is the Renters' Rights Bill. So this is a new piece of legislation designed to make the renting environment better for renters ultimately. But although in an ideal world, none of these things would affect a landlord's ability to earn money and have a good investment, it is likely to add a bit of friction to the market. And in some of the worst case scenarios, it would be quite bad for landlords. So evictions are now only possible with a valid reason, which are things like antisocial behaviour or not paying rent, but the process for enforcing that is harder than just having the ability to remove tenants just because you want to. Notice periods have increased when evicting a tenant, which means there'll be a longer period where you can't get a new tenant or you can't increase rents. Rent increases have been restricted, so rent can still be increased, but it's harder to do so. It can only happen once per year. It can only be capped at market levels. And finally, there are increased penalties for not meeting certain health and safety standards. So again, things that should all be in place anyway, really. You wouldn't expect to be able to charge more than the market level of rent. You wouldn't hope to rent a property and not to meet the normal health and safety standards. But as a general package, it's likely to increase friction, and it has meant that we've seen lots of landlords looking to sell. It's not just the Renters' Rights Bill, it's also some of the other factors, but it adds up to landlords thinking it's going to be harder to make money. So now we're going to look at a financial comparison between pension investment and the property investment. So here we're looking at somebody with £50,000 to invest, and we're going to start by looking at the net value once they've made the investment. So we'll start by looking at the buy-to-let property. They're going to buy a property for just over £160,000, and they're going to get a mortgage for 75% of the value. They're therefore going to require a deposit of just over £40,000, and they're going to pay some costs to get started, buying some new furniture, doing some decorating, and they're going to pay stamp duty, of course, on this second property they're now buying. So they've spent £50,000 to get started. With the pension contribution, they're also starting with £50,000, but because they get tax relief, that pension contribution is grossed up, and they also get some tax relief because they're a higher rate taxpayer. So they've actually received 66,000 into the pension in total, but they've also received the tax relief. So the net value of the pension contribution equates to £58,333. And with the property, because they've had to pay some costs, the net value is close to £40,000. And as I mentioned at the bottom there, future returns, though, will depend, of course, on the growth rate. So does the pension perform better? Does the buy-to-let property perform better? It's going to depend on mortgage rates, and it's going to depend on the taxation of those two different types of investment over time. We'll look at an example of that now. So apologies, I've skipped forward. If I go back to where we were, this is where I wanted to come to. So this chart looks at those same figures and it projects forward over time. So starting with the pension portfolio, you can see we have the starting figure of £50,000 contribution, and because of the tax relief, that increases. So you actually get a higher level straight away because the pension is larger, and then you get tax-free growth along the way. With both of the property examples I look at here, and I look at a 2% capital growth rate and a 3% capital growth rate, you can see over time the 3% capital growth rate does catch up with the pension, because it's also getting the rental income, but we're taking quite a long time to get there. With 2% capital growth, it just doesn't get there, but it's still assuming a 5% yield, and it's assuming that capital gains tax is paid on the gains there as well. So these projections are quite sensitive to the assumptions you use. So it could be that you think you can get a yield that's much higher than the 4.75%, which is the current UK average. It could be that you think the expenses I've used here of 10% of the yield are quite pessimistic, although it can often be much higher than that. But this just gives an indication that if capital growth isn't 3%, it's going to be quite difficult to catch up with the pension, and we've only assumed 5% of growth there. If the capital growth was zero, it would look much worse still. So it's not an easy win, certainly, to invest in a property, especially a second property, and due to some of this punitive levels of taxation and mortgage rates being quite high at the moment. So when thinking about what to do, at Netwealth, we certainly help clients with pensions. And when clients come to us for financial advice, we certainly factor in their property investments as well. And we also look at things like, should you repay a mortgage, and what's the benefit of repaying a mortgage versus investing elsewhere? Because repaying a mortgage, in some senses, could be seen as disinvesting from property and reinvesting elsewhere. So looking at the service we offer to clients, we combine, we think, expert advisors with technology and bring them together in a really cohesive way to deliver better net returns to clients. So the expert advisors come in when it comes to setting up the portfolios, helping you choose the right level of risk, the right account types. With the investment side of things, it's our investment team helping clients maximize their return for a given level of risk. But then we also use technology in some really clever ways to help clients with some of the points you can see on the bottom of this circle here. So that's cash flow modeling, that's utilizing tax allowances where available, it's analyzing scenarios, and very importantly, it's keeping costs down so that those fees don't act as a drag on the performance of your portfolio. Moving on to the fees at Netwealth, you can see those on your screen here, and it depends on whether you offer our core service or our advice service, where you benefit from full financial planning advice. But with investment management only, our fees range from 0.75 to 0.35, depending on how much is invested. Our advice service is 0.35% per annum higher. And I've just mentioned at the bottom there the cost of having a pension wrapper at Netwealth, particularly because we had a question beforehand about how important it is to be mindful of fees and how there can be lots of hidden fees. So I wanted to make it very clear that our pension costs £180, including VAT per annum. And the question also asked how clients can find out how much they're paying for their existing advisor. And there isn't an easy answer there because lots of different providers quote their fees in different ways. But the key is to either look very carefully at your annual report or just ask the question directly if you have a financial advisor, the total cost of supply for the service I'm receiving. But you can see with us, if you had £1 million, that pension would equate to 0.04%. And then that would just be added to the fees you can see in the table above, essentially. And on the next slide, I'm just going to look at our fees over time relative to a traditional wealth manager. Because as I touched on, we're a modern wealth manager, we do things slightly differently. And one of those things is having much more cost-effective fees. So here you can see someone starting with £1 million and how that looks over 20 years. So with Netwealth, we've assumed they're on our 1.1% fee rate, including ongoing advice to help them plan and think about how much they might be able to spend in retirement, say, or how they should deploy their capital in the most efficient way. You can see that after 10 years, the 1 million has grown to 1.6 million nearly with Netwealth, but it would be 1.46 with the traditional wealth manager paying about 1% more in fees, so 2.1% instead of the 1.1%. You can see after 20 years, that difference has grown quite a lot. So with Netwealth in this scenario, they'd have 2.5 million. With the traditional wealth manager, it would be 2.2 million. And that's with the same investment strategy, the same level of risk, just paying less in fees, and they've managed to save quite a lot of extra money in their portfolio, which they can potentially pass on to their children. So, and finally, on this topic, I wanted to look at a brief case study of a chap called John here, who is looking at retirement. He's 5 years away, he's saved into his pension, he has multiple pension pots, and this just gives an idea of the sorts of ways we work with clients to help them on some of these topics. So John here wants to pay off his mortgage before he retires. So again, it's using some of his capital actually to reduce the amount he owes the bank, so getting rid of that mortgage because it's not helping his net return, say. And you can see here, we've done some cash flow modeling for John. So he's taking up some financial advice and retirement planning. He's looking at these key junctures in his life, and state pension comes into payment. He starts his retirement income and he repays the mortgage. And you can see just a brief indication of what a projection might look like that shows that he's on track. He's not going to run out of money. And he might look at another scenario where he doesn't repay the mortgage to show the comparison there and whether it's worth doing or not. Because although it is often worth reducing debts, particularly if interest rates are high or increasing, it could be that you're locked into a very attractive rate, in which case you wait some time before repaying it. Great, so thank you very much for joining me today. So in summary, we think it's very sensible for people to own some property. Not everybody will want to, but for most people, they'll need somewhere to live, and there are attractive benefits for your primary residence. You don't pay capital gains tax, for example. But often clients have lots of exposure to UK residential property with their own home. So they should certainly consider the lack of diversification and the lack of liquidity before purchasing more property. Pensions and tax-efficient wrappers can deliver very attractive returns, net of tax in particular, because there is no tax, which certainly helps. And it's very useful to use allowances for you and your family, especially because they can be lost if they're not used. So whilst it's better for property when you're making a comparison once you've already used your pension allowance or once you've already used your ISA allowance, if those allowances are still there unused, it could be a good idea to think about those first before buying a buy-to-let property, say. As touched on, you can use up to 3 years worth of unused pension allowances, so you can potentially invest quite a bit more into your pension than you first thought. And we did actually have another question from somebody who mentioned the fact they had left it quite late to build up a pension, and should they invest in a pension or property? And I would say it's never really too late to invest in a pension unless you're over the age of 75, because then you don't receive tax relief. But for those that are before the age of 75, even if you only pay in 1 year's contribution, you still get tax relief for that 1 year. So it's still really attractive. So it's never too late to get started there, and you might be able to pay more than you think. And finally, it's really useful to review your wider financial plan. And if you're unsure, or if you have particularly complicated circumstances, then certainly consider some advice. And if you consider some advice in Netwealth, we'd be very happy to hear from you at advice@netwealth.com. Thank you very much for joining me today, and I hope you enjoy the rest of your day.